this opportunity. I would like to structure my presentation into very simple 4 parts. The part 1, I am going to speak what exactly you should expect from me in less 20 minutes that has been allotted to me. Part 2, what is the background of our group. Part 3, about the fund. In fund, I am going to tell you only 4 things. Point number 1, exit. Point number 2, entry. Point number 3, where do we make money? Paisa kahan kamate hain? And point number 4 is what is your safety. After hearing all those things, you might find it slightly technical. Don't worry, in the end, I am going to cover in absolute non-technical way. So let's start with the first point, what is coming your way. So there is a segment called as startup, and there is a segment called as a listed. Between startup and listed, there is a segment which is called as a pre-IPO. In pre-IPO, which is companies which are likely to get listed in 2 to 3 years times, that is the golden spot. So you are neither having the, I am not using the word risk, neither having the issues that we are normally facing in a startup, nor having the so-called high valuations that you are having in the listed market. So this is a perfect combination where you can have the, you can enjoy the benefits of both the worlds. In terms of number of opportunities, if you are asking me, then the listed market versus unlisted market, the opportunities are maybe 500 times or 1000 times. If you compare the number of unlisted companies versus number of listed companies. So that's the universe. And how do we hit the target where we can exactly hit the listed market? That is what exactly I'm going to demonstrate. So next 20 minutes, we are going to speak on that. So one thing I would like to mention over here is that in unlisted segment, it's a proven fact that you tend to make, it's a bold statement, you tend to make more money than the listed segment. You Google it, you will come to know. And I'm not the first person to say this. If you ask me reason why, simple reason. Suppose you're entering any sector, if the listed P multiple is 40, unlisted you will come at 30, for the simple reason, listed you can buy Friday, sell Monday, unlisted you cannot do that. So that's the holding period premium you are getting. But in my opinion, that's a half statement. In unlisted, you tend to make more money than the listed segment. That's a half statement. The full statement is, in unlisted, you tend to make more money than the listed segment, provided your fund manager knows how to make an exit. That is what the whole issue is nowadays. Most of the people are not finding it easy to do the exit. So if you know how to make an exit, then the returns are assured. You are going to get the returns. So that exactly we are going to speak how to launch a exit oriented fund. Returns come later, exit come first. So how does the group background help us? By default, the easiest and the most easiest option for the exit is IPO. You all know that. So what is the background of Pantomath Group? As a Pantomath Group, we are India's largest mid-market merchant bank. What does it mean? We have executed 109 IPOs in India in last 10 years. In terms of number of IPOs, we stand number 4 into the country. The first 3, needless to say, are the banks. In non-banking, we are number 1. So that's the core credential of the group. They know what is required to make an IPO. I would like to also mention about our group entity, which is Asit C. Mehta, where Pantomath Group has more than 50% shareholding. Asit C. Mehta is basically 40 years legacy into the listed market. So right now, Pantomath plus Asit C. Mehta, so this is the point of listing that we are talking about. So Pantomath is a champion of this part, the left side of the table, and Asit C. Mehta is a champion of the right side table. Both have their own histories, and that is how, if you talk about the entire circle, about the listing and post-listing, we have the perfect combination. So that's about the background of the group, how the background of the group helps us in making the exit. Let's quickly see the fund. I'm going to tell you only 4 things. First, exit and then entry. If you open the books, you will come to know that traditionally the fund management is all about enter first, nurture the company, and then exit. That's right. That's right. But imagine if you already spot the exit. You know, 1 year or 2 years down the line, I'm going to exit here. And then if you back calculate and enter, the probability of exit increases. So how do we do that? So let me tell you, where do we exit? Dashnik, if you can. So this is the point of IPO. Most important, we want to exit on the day of IPO. For the simple reason, on the day of IPO, your stock is 25% liquid. Under the regulator's observation, somebody is buying and somebody is selling 25% of your stock on the day of IPO. At no point in the history of your stock will be so liquid as it is on the day of IPO. So get out, जिसको हिंदी में बोलते हैं बहती गंगा में हाथ धो लो. Get out when your stock is most liquid. Get out on the day of IPO. Listing gain and all those things, today you are seeing it, it's okay, market is all-time high, but not necessarily always you will get it. Second, when you get out, freeze the valuation also. I want to get out at a valuation not above 4,000 to 5,000 crore. Question why? Answer simple. Last 5 years, has India witnessed at least 5 IPOs above 5,000 crore being successful? The answer is no. If I ask you how many IPOs below 3,000 crore India has seen successful, the answer is 3 digits. Each and everything you do has a budget. So maybe the India's budget is below 3,000 crore. So reason I am saying I want to get out at 3,000, 4,000 crore or less than valuation on the day of IPO, because it is easily doable. So now I freeze my point where I am going to get out. Now let's see what is the entry. So this is the entry. Now what is my entry? Point number 1. You cannot do IPO by bringing 2 investors. You have to get HNS also, you have to get retailers also, you have to get institutions also, you have to get QIBs also. So basically, jo dikhta hai wo bikhta hai. You buy what you see. So invest into the asset-backed company. I know I'm talking in the capital market of softwares, nothing wrong against that. But asset-backed companies are easily sellable. If you try to go and explain it to retailers, they will understand very easily what is the asset-backed company. If they understand, they will invest. So point number 1, invest into the asset-backed company. Point number 2, invest into a company which is having a top line of minimum 300 crore and not about 3,000 crore. Why? Very simple. You take any manufacturing company that you know. I'm not talking about retail, I'm not talking about trading, I'm talking about manufacturing company. 0 to 100 crore, 0 to 150 crore, 0 to 200 crore, promoter keeps struggling. But imagine once he has achieved the top line of say 200 or 300 crore. That's where we call it, he has got the pulse of the business. At the time when he has got the pulse of the business, at that point you gave him money, you gave him corporate governance, you gave him artificial intelligence. In 3 years time he has to grow because he has got the pulse of the business. So there is no startup, again I'm not using the word risk, but the issues that you are facing, that's not there. So invest into the asset-backed company having top line more than 300 to 3,000. Third, there are various multiples floating into the market. P multiple, EBITDA multiple, revenue multiple. Just now somebody was asking me, there is new multiple, footfall multiple. Friends, believe me, if you want to get a good anchor investor on the day of IPO, because if you get a good anchor, by default your IPO is going to oversubscribe. Then on this day, you have to talk the language of P multiple. Now, P multiple language can be spoken by only those guys who have PAT, that is profit after tax in your books. The issue is in most of the people unlisted, they do not have the PAT. So we invest only into the PAT positive companies. Probably one of the rare fund managers into India in the category 2 segment having all PAT positive companies. Third point, I think that's the epicenter of the presentation. The day we invest, promoter should have minimum 90% stake into the business. Heavily diluted companies are difficult to IPO. Now these are my entry criteria. Last point, whatever money I'm investing, say I'm investing 50 crore into the company, the gross block of the company should be minimum 2.5 times of what I'm investing. Sir, asset-backed company, PAT positive company, having 400 crore top line, promoter 90% stake, such kind of a companies, I don't think anybody have seen going bankrupt or becoming zero. That's impossible. Unless something horribly goes wrong, then the whole industry has some kind of issue. So that's what we are doing, a brick and mortar model. Traditionally, India has earned money like this. I am not inventing the new thing. Traditionally, we have made the money like this. So I have told you where do I exit. I have told you where do I entry. Let me very quickly tell you what are the last 2 points. Where do we make money? Paisa kahan kamate hain, most important. By now, you must have guessed one thing. I am going to play the game of P multiple. P multiple ka simple formula hai PAT, profit after tax, multiply by the P multiple is equal to valuation. A multiplied by B is equal to B. See, I never told you I'm taking a bankrupt company and trying to make it positive. I never told you I'm taking a 10,000 crore company and trying to make it positive. Neither I told you I'm taking a loss-making company and trying to make it positive. But already a PAT positive company, promoter knows how to make the business, give him money, give him corporate intelligence, and give him artificial intelligence, give him corporate governance. In 3 years' time, he can grow the balance sheet. If you see my first funds investing company, last year's PAT versus this year PAT, in 1 year they have triple it. That's very easy because chote ko bada karna hai. So that's where I'm increasing the A. A is my PAT. Let's talk about the B. B is very simple, P multiple. Unlisted to listed, it is your fundamental right to come at a low discount. I have done 109 IPOs by simple doing Unlisted come at a lower multiple, listed get out at a higher multiple. So that game I know very well, better than anybody else in India. Simple 4th standard mathematics. Double A, which is PAT, in 3 years, double P multiple in 3 years, valuation by default goes 4 times without doing anything. Double the PAT, double the P multiple, valuation by default goes 4 times. If you ask me, my first fund's average entry level P multiple is 11.5. Beat that, 11.5. First of all, I'm talking the language of P multiple because I have the leverage to talk, because I have all PAT positive companies. Unfortunately, very few people can talk that language. You also know today IPOs are not coming below P multiple of 30. So that is traditionally where we are making the money. We saw exit, we saw entry, we saw where do we make money. Last point, safety. Safety is very simple, sir. Equity, you all know, is not as safe, but the way we are making our shareholders agreement, we are trying to make safe. So in my any shareholders agreement, you will have 3 clauses, very standard, without any negotiation. First, the day I am investing, the promoter of the company has to get IPO in 30 months flat. If he is not, many people ask me, if he doesn't say, I said, I'll not invest, as simple as that. The market is too big for me. So he has to bring the IPO in 30 months. Now, which are these companies? First of all, these are smaller companies. Second, asset-backed company, everybody understands. Third, our own name is there. We have the history of doing 100 IPOs. So the probability of IPO is extremely high. But let's talk downside. What if the IPO doesn't come? First of all, it will not happen. Probability is very less. But if it doesn't happen, immediately 2 clauses trigger. By now, you must have guessed which are those 2 clauses. Clause number 1, I have right for a stake sale. You might say that is with everybody. Yes, it is with everybody. But having a right of stake sale with a promoter having 30% and having a right of stake sale with a promoter having 90% is a huge difference. Imagine you are having 90, I am having 10. You will never ever allow me to sell my 10% to your competitor. And your competitor would be more than willing to buy that 10% because otherwise he will not get entry into your company. So that's where I'm automatically pushing him to go to the 3rd clause. And the 3rd clause is straight away, it's called as a buyback. Each and every shareholders agreement that we have entered, promoter has given me in writing that they will buy me back at 18 to 24% IRR. Again, having this clause with a startup promoter and a 900 crore company is a different. Having this clause with a promoter having 30% stake and a promoter having 90% stake is a huge difference. A promoter having 90% stake, top line 900 crore, 800 crore by now. If he gives you in writing, something goes wrong, I will buy you back at 18 to 24% IRR. At least that much trust you have to keep, otherwise do not invest into the equity market. So that is how we are ensuring the safety of the people. So that is the reason what has happened is that if you try to apply for the IPO, most of the people are not getting it. And the most important factor here is that people are taking a lot of time to deployment. But since we are into this market for last 10 years, by default, the opportunities knock our door. So now this technical presentation ends. I have given only last 6 minutes. If you have understood, I'm sure everybody has understood this. If you have not understood, forget it. Let me tell you in a complete different 360-degree different approach. Each and every business, your business, my business, this hotel business, each and every business has 2 sides. One is buy side, one is sell side. Manage the buy side, manage the sell side. By default, you're going to make the money. So what is my buy side and how do I manage it? My buy side is none other than the promoter of the company. Take any 400, 500 crore top line promoter of the company. From 500, he has to go to 5,000, or from 400, he has to go to 4,000. What are the steps in India? Number 1, appoint a financial consultant. Number 2, the financial consultant will bring the private equity investor. The private equity investor has his own dance and drama. He will tell promoter, you give me the exit. So to give the exit to the promoter, you have to appoint a merchant banker. Then go to the SEBI and get the approval. Then bring the anchor investor. Without anchor, IPO is impossible. Bring the IPO and manage the post-IPO scenario. Friends, if you see the mid-market promoters, where are they? They are not in their dent. They are sitting in Nariman Point. That's a place in Mumbai or a BKC in Mumbai because most of the financial consultants are there. If the promoter is sitting in a financial broker's office, that means he's not managing business, he's managing finance. So when the same promoter comes to me, I have artificial intelligence which tells me his company is clean. In flat 10 minutes, the listed company data that you get for any unlisted company I get, the company GST default, TDS default, promoter, criminal liability, everything I get to know in 10 minutes. I come to know I can bring the IPO. Now my offer to promoter is very simple. From tomorrow onwards, your financial consultant is me. I am your private equity investor. I know how to do the IPOs. I'll only get your IPO. I'll only bring the IPO and post IPO I am going to manage. From tomorrow onwards, do not do anything. Sit in your den, do not come to Nariman Point. Sit in your den, take my money, take my artificial intelligence, take my corporate governance, take everything from me. In 3 years, just try to take that 400 crore top line to 800. Promoter takes that bet because he gets a one-stop shop. Now, this is not a charitable institution. In return, what I expect, I tell him, I am putting money for 10% equity, give me at a 50% discount. Why my P multiple is 11.5 whereas market is trading at nothing below 30? Simple, because I asked 10% equity at a 50% discount and promoter takes it. Why? Because if he tries to raise a private equity funding from the market, the cost of fundraising is nothing less than 6 to 7%. Plus average waiting time is nothing less than 8 to 9 months. So it doesn't have to, so 10% equity at a 50% discount, how much loss? 5%, 4% loss? So he takes that bet. He gives me 10% equity at a 50% discount because he knows he is my one-stop shop. So what I'm trying to do, enter at such a low level that you should not be bothered on the exit day where the market is there. 11.5 P multiple is rock bottom. I would be surprised if somebody is entering below that market level. That too also a PAT positive company, promoter having 90%, such a golden company at 11.5 P multiple. It's a very good thing. So that is where I earn my buy side. Now let's see where in 2 minutes, I know you're already stood up. Where is my sales side? My sales side is very simple. My sales side is India's strongest animal called as mutual fund. Today nobody has more money than mutual fund. 18,500 crore rupees they get at the start of every month. They have no option. What government of India has done that, सब लोग IPL देखते हैं, entire cricket team is selling mutual fund. Sachin, Dhoni, Sehwag, everybody is selling mutual fund. The mutual fund has become very big. Now this mutual fund industry became very big. Their issue started, which is the issue faced by all the rich people. Where do we invest? They are not investing outside India. Neither they are allowed to invest into the listed. So they have to invest into the listed segment only. So indirectly, I am preparing food for the India's strongest and the wealthiest animal called as mutual fund, because they can invest only the post-IPO company. And how government of India has helped them, because only post-IPO mutual fund can invest, and they have a deployment pressure. If you look at my last 8 IPOs at an institution level, they have been 150 times subscribed, whereas retail level they are average 30 times subscribed. Is like BMW got sold more than the Maruti 800 because of the deployment pressure that mutual fund has. So what government of India has done, why IPOs are coming. In last 1 minute, I want to explain why IPOs are coming and why it will continue. As long as mutual fund is growing, IPO has to come, because only post-IPO is the food for mutual fund. And what government of India has done is, whenever somebody invests pre-IPO, you have a lock-in period. At one time, the lock-in period was 12 months. Because once you invest, you cannot get out for 12 months. 12 months has come to 6 months. 6 months has come to 3 months. Now the effective lock-in is 50% 1 month, 50% 3 months. Means imagine I am a head of a mutual fund which is having a, which earlier could do 4 IPOs in a year. Now with the same amount of money, I can do 24 IPOs because my lock-in has come down effectively from 12 months to 2 months. So that is how they increase the churning into the market. So as long as mutual funds are growing, number of IPOs are definitely growing into India. So if you think the mutual fund industry is going to go down, you do any business. If your buyer becomes weak, your business is going to fall. And my buyers are mutual fund. If you think that mutual fund industry is going to come down from monthly 18,500 to 8,500, this is a risky. But if you think this industry is going to go from 18,000 to 30,000, rest assured, you know the result. So that is how everything has been there.